Welcome back to today's deep dive. Today's deep dive is about a project that sits right at the center of modern crypto infrastructure, yet continues to confuse people more than almost any other major network. Not because it doesn't work, not because it lacks users, and not because development has stalled, but because it exposes a structural truth that many people still aren't comfortable facing. We're talking about Arbitrum. Arbitrum is one of the most widely used scaling solutions in the entire Ethereum ecosystem. It processes millions of transactions, hosts some of the deepest DeFi liquidity in crypto, and plays a critical role in keeping Ethereum usable at scale. And yet, when people look at the Arbitrum token, they often feel like something doesn't add up. Usage is high, activity is real, but price performance has been inconsistent, capped, and often disappointing relative to expectations. This episode is about why that disconnect exists, and why it is not accidental, temporary, or irrational. To understand Arbitrum properly, you have to stop thinking like a retail trader and start thinking like a system designer. Because Arbitrum is not a speculative experiment, it is infrastructure. And infrastructure behaves very differently to assets designed for direct value capture. Arbitrum was created out of a very specific problem that became impossible to ignore during Ethereum's early growth years. As decentralized finance and on-chain applications began to take off, Ethereum's base layer simply could not scale fast enough without sacrificing usability. Fees spiked, transactions slowed, and everyday users were priced out during periods of demand. It became clear that if Ethereum was going to function as a global settlement layer, it would need secondary execution environments that could handle volume without compromising security. That problem is what led to the creation of Arbitrum by Offchain Labs, a research-driven blockchain company founded by academics and engineers with deep backgrounds in cryptography and distributed systems. Offchain Labs was established by Stephen Goldfeder, Harry Kolodner, and Ed Felton, a former U.S. Deputy Chief Technology Officer, with the explicit goal of scaling Ethereum without abandoning its security model. Rather than building a competing chain, their approach was to treat Ethereum as the anchor layer and move computation elsewhere, only returning to Ethereum for verification and final settlement. Arbitrum's design reflects that philosophy. It prioritized correctness, security inheritance, and compatibility with existing Ethereum tooling over experimental speed or radical redesign. From the outset, it was built to feel familiar to developers, integrate seamlessly with Ethereum smart contracts, and reduce friction for users, even if that meant delaying or de-emphasizing token economics. This origin story matters because it explains why Arbitrum looks the way it does today. A network engineered first as infrastructure, not as a token-driven economic system. Arbitrum is a Layer 2 network built on top of Ethereum, using optimistic rollup technology. What that means in practice is that transactions are executed off Ethereum mainnet, bundled together, and then posted back to Ethereum for final settlement and security guarantees. Ethereum remains the court of final appeal. If there is a dispute, Ethereum resolves it. If something breaks, Ethereum is the base layer that enforces correctness. This is not a small detail. It is the defining characteristic of Arbitrum's design. Arbitrum does not attempt to replace Ethereum. It does not compete for validator sets, monetary premium, or base layer dominance. It explicitly accepts Ethereum's sovereignty and builds on top of it. That decision gives Arbitrum access to Ethereum's security, credibility, and liquidity, but it also limits what Arbitrum can economically claim for itself. This trade-off is at the heart of the entire ARB discussion. By usage metrics alone, Arbitrum is a clear success. It regularly ranks near the top of all Layer 2s for daily transactions. It has consistently high active wallet counts. It hosts major decentralized exchanges, perpetual futures platforms, lending markets, structured products, gaming applications, and NFT ecosystems. Liquidity is deep, slippage is low, and developer tooling is mature. In other words, people are actually using it. This is important to say out loud, because a lot of surface-level crypto commentary still tries to frame weak token performance as a sign of network failure. That argument does not apply here. Arbitrum has not failed to attract users. It has not failed to attract developers. It has not failed to integrate into the broader Ethereum economy. What it has failed to do, at least so far, is convert that success into a clear and immediate value proposition for its token holders. The ARB token is a governance token. That is not marketing language. It is an accurate technical description. What ARB does not currently do is capture fees, accrue yield, or represent ownership over protocol revenue. ARB is not the gas token. Users do not need it to transact. Fees are also not paid in it. Fees are not burned in it either. There is no automatic distribution mechanism that sends revenue to ARB holders. There is no staking yield tied to network usage. There is no dividend-like flow embedded in the protocol. This is where most expectations quietly break. For years, crypto markets trained participants to believe that usage automatically leads to token appreciation. That belief held during periods when liquidity was abundant, narratives were dominant, and structural details were ignored. But this cycle has been different. Capital is tighter. Risk tolerance is lower. And markets are asking harder questions about how value actually moves through a system. Arbitrum forces that question into the open. The network generates economic activity, but that activity does not mechanically create demand for the token. As usage increases, ARB does not become scarcer. As transactions rise, ARB is not consumed. As liquidity deepens, ARB does not become more necessary to hold. So what drives the demand? At the moment, demand is driven almost entirely by expectations about the future. Expectations that governance may one day redirect fees. Expectations that sequencer decentralization may involve token economics. Expectations that ARB's role may expand beyond governance. Expectations that Ethereum's growth will eventually lift all of its scaling layers. Expectations are not cash flows, and markets discount expectations aggressively. This makes ARB structurally fragile in ways that are easy to misunderstand. The token is not failing, it is waiting. But waiting assets do not perform well in impatient markets. Supply dynamics make this even harder. When it launched, a large portion of total supply was allocated to early investors, core contributors, advisors, and its treasury. Much of that supply was locked under multi-year vesting schedules. These unlocks were known in advance. They were documented. They were transparent. And yet they still matter. Token unlocks do not need to trigger panic selling to suppress price. Markets are forward-looking. Traders position around unlocks weeks or months in advance. Buyers hesitate. Rallies stall. Risk managers reduce exposure. Even if unlock recipients never sell aggressively, the possibility that they could sell is enough to cap upside. This creates persistent overhead pressure that is difficult to overcome without a strong, mechanically driven demand narrative. Arbitrum has had to absorb new supply entering circulation while simultaneously offering no direct revenue capture to offset it. That is a difficult environment for any token, regardless of how strong the underlying network is. Governance itself, while important, is also often overestimated as a source of demand. In theory, ARB holders collectively steer the protocol. In practice, voter participation is relatively low. Outcomes are dominated by large holders, and most proposals do not materially alter token economics. Governance shapes direction, but it rarely creates immediate value for passive holders. This limits organic demand for ARB outside of long-term alignment or speculation. Another critical element is the sequencer. Today, Arbitrum relies on a centralized sequencer operated by Offchain Labs. This improves user experience, reduces latency, and simplifies operations. But it also concentrates economic control. The sequencer is one of the most important components of a rollup. It orders transactions. It captures fees. It sits at the center of the system. At present, the economics of the sequencer do not accrue to ARB holders. There are long-term plans to decentralize sequencing. If that happens, it could meaningfully change Arbitrum's economic structure. Sequencer decentralization could introduce staking, fee sharing, or other token-linked mechanisms. But until those changes are implemented and proven, they remain optionality, not fundamentals. Markets do not price optionality generously in uncertain environments. This is where comparisons to Solana often surface. and it's important to be precise about them. Solana is a monolithic Layer 1. It controls its execution, settlement, and security within a single system. Fees are paid in Sol, and validators earn it. Usage creates direct demand for the token. The economic loop is tight and visible. Arbitrum is not designed that way. It deliberately offloads security to Ethereum. It optimizes for scale and efficiency, not sovereignty. That makes it less risky in some respects, but it also makes token economics more indirect. Solana behaves like a business. Arbitrum behaves like infrastructure. Infrastructure is essential. It is widely used. It underpins entire ecosystems. But it does not always generate speculative returns unless pricing models are explicitly designed to do so. So what would actually change ARB's trajectory in a meaningful way? If governance were to implement fee sharing, token burns, or staking models that tie ARB directly to usage, the value proposition would change. If sequencer decentralization introduced token-based economics with real participation requirements, demand could increase. If unlock schedules completed and supply pressure diminished, confidence would improve. If DAO treasury policy became more predictable and less emission-driven, the market would respond. And if Ethereum itself enters a phase of sustained growth, Layer 2s like Arbitrum benefit indirectly, though that alone still does not solve value capture. The broader lesson here is uncomfortable but necessary. This cycle is forcing crypto to grow up. Markets are no longer willing to conflate network success with token appreciation. They are separating useful systems from investable assets. That separation is painful for holders who expected narratives to do the work. But it is healthy for the ecosystem. Arbitrum is not broken. It is not dying. It is not failing. It is doing exactly what it was designed to do. The open question is whether the token is ever redesigned to benefit from that success, and whether governance has the will to make that change. Until then, ARB will likely continue to behave the way infrastructure tokens behave in disciplined markets: useful, important, and constrained. Understanding that distinction is the difference between confusion and clarity. Drop your thoughts in the comments, smash like, follow for the next deep dive, and as always, we will see you at the top.